All right, moving on then. And speaking, we are now getting on board Priyankar Biswas, who's the Industrial Logistic and Research Analyst, JM Financial, joining us. Hi, thank you so much, Priyankar, for joining us. Priyankar, as I can see, as far as the data center pipeline is concerned over FY25, 2025, 2030, it is likely to grow at around 22%. What is the kind of growth that you see for data centers in India?
Yeah, thanks for having me. So data centers, we think that from a level of roughly like a 1.5 gigawatts we have today, we would probably reach somewhere close to 5 gigawatts times by like 2030. That's on the present pipeline. So that is sort of the growth you can expect. And of course, most of this growth would be the co-location space, almost like 90% of that. And we have actually put out some things on that, and we can say that this sort of strong growth has like positive impacts across the space that we look at, that is particularly industrials.
All right. Also, are you seeing any demand slowdown, or order books is still strong for you?
Specifically for data centers, what I will say is that there is no such slowdown as such. In fact, the things are accelerating as we speak. The pipelines are fairly quite robust, like looking forward into the next couple of years. And we are seeing that reflected in company results as well, in a sense. However, if your question is mostly on the overall industrial space, it's sort of a mixed bag, I would say. While we had quite good order inflow momentums in something like Siemens India, we cannot say the same for ABB, where we had a order inflow decline. So a mixed bag, but core guys like L&T continues to do exceptionally well on order inflows.
Right. Also, talk to us about the momentum as far as private capex is concerned versus public capex momentum.
So, as far as private capex is concerned, there are kind of you can say deferral of projects that are happening. So, especially like steel and a few others. So this is something that has been flagged by managements like ABB also in their calls, and like big ticket projects are getting deferred. However, having said that, in certain spaces like data centers and power transmission, which are also in a sense mostly private in nature at the moment, like PPP in a sense, so there we continue to see and expect to see going forward like steady momentum ahead. As far as the government capex is concerned, there was earlier a concern that post the GST cut that the government capex would meaningfully slow down, but that may not be entirely the case. We are still seeing, let's say, relatively robust momentum in spaces like defense. Also, we highlighted about power T&D, which does not depend too much on, let's say, direct government funding. And the main space that we continue to see headwinds, like in a public capex, happens to be the water related space, where we are seeing sort of a build up in receivables and lack of ordering.
Also, Mr. Biswas, talk to about how is weak global demand affecting the order flows in the engineering goods, textiles and the auto components?
So textiles is not something that at least I as a sector that we look at, neither is auto components is something that we look at. But like at least on our coverage space, what I can tell you is that if it is on the EPC side of things, like for example an L&T or a KEC, there is a strong, robust Middle Eastern capex pipeline on both oil and gas and transmission. So orders are still flowing in over there, and they continue to be healthy. However, in certain other more like the generic cap goods names, so we are seeing some kind of a softness.
Okay, so that's as far as the industrial sector is concerned. Mr. Biswas, afternoon, Ashesha this side, and since you also track the logistics sector, let's also talk about that. What kind of demand trends are you seeing across all modes, whether it is rail, road, or via any other kind of mode that you track, and how are demand trends shaping up across the sector?
So let's first talk about railways. So railways, it is always known that it's a more eco-friendly way of transporting cargo. But having said that, the rail modal shares are not showing any signs of improvement as we speak, and this has let's say reflected in relatively modest type of volume growths in name like container corporations. So that anyway where they're in, let's say, the results per se, like when we look at, let's say, a container corporation type originating volumes. So that is one issue that we are clearly seeing. On the ports side of things, while there is a issue related to iron ore exports from the country, so that has impacted volumes somewhat. However, the container trade data as far as the ports is concerned has relatively remained robust, and that has sort of helped in the profitability of certain large players like, let's say, Adani Ports.
Understood. So that's as far as demand trends are concerned. But then what about pricing?
So from a pricing point of view, so the depreciation of the INR versus the USD had clearly helped somewhat because a lot of this pricing is often USD denominated, so that has the positive effect, so as to speak. We have generally seen reasonable demand, and the pricing as far as port logistics companies are concerned, including related to import of liquids or LPG, for example, Aegis Logistics, all those have remained quite firm, is how I would say. There is no perceptibly negative impact. I would, on the contrary, say that pricing resilience has been shown.
Okay, so that's as far as pricing is concerned, but government has also undertaken several initiatives to support the logistics sector, not only through the national logistics policy, but just 2 days ago we had Railways Minister come and reduce, they've changed the freight policy as far as pricing is concerned. What do you make of the government support to the entire logistics sector, and what kind of benefits is the industry enjoying on account of that?
So what I have seen recently is probably what you are referring to is about movement of cement specifically. That is what we have noticed of late. This may have some positive impact as far as movement of cement on containers is concerned, but having said that, it may not move the margin too much on container related let's say rail logistics players, because generally speaking, margins on the domestic segments, that is where this policy has a stronger effect, is relatively small or lower in the mix. So not much of an impact, I would say, at this level from, let's say, the cement transportation via containers policy that was introduced, let's say within last week.
Understood. So that's the view when it comes to the industrial sector and the logistics sector. Thank you so much for taking your time out and joining us today from the sidelines of JM Financial Conference, and we look forward to interacting with you more often right here on ET Now. On that note, we need to slip into a very short break, but we'll continue our coverage on markets on the other side. Don't go anywhere.